Washington is about to test the world's confidence in America's financial power, live in real time. The U.S. Treasury has announced a massive $119 billion bond auction. Now, at first glance, that may sound like just another government finance story buried in the business section. But in reality, this is no routine event. It's a stress test, one that could shake not only America's economy but the entire global financial system. Because here's the truth. U.S. Treasury bonds aren't just pieces of paper. They're the backbone of global finance. For decades, they've been treated as the safest asset on Earth, the gold standard of trust. Central banks, pension funds, and investors everywhere have built their financial security around them. And now, with deficits exploding, interest payments ballooning, and foreign buyers stepping back, the question is simple but urgent. Will the world still line up to buy? Before we go deeper, I'd love your support. If you're finding this breakdown valuable, please hit the like button and share this video with a friend who follows global economics. It really helps more people understand these big shifts. Now let's unpack what's happening here. For generations, U.S. Treasuries have been seen as untouchable, almost risk-free. If you bought a Treasury bond, you could sleep at night knowing America would always pay you back. Pension funds relied on them to secure retirements. Insurance companies used them to balance risk. Even foreign central banks from China to Europe stacked them up like bricks in a fortress of financial safety. Buying U.S. debt wasn't seen as a gamble. It was as safe as it gets. But here we are in 2025, and that certainty is cracking. The U.S. government is borrowing at breakneck speed with deficits running over $2 trillion a year. To put that in perspective, Washington now spends more just on interest payments than on national defense. Think about that for a moment. The world's most powerful military costs less than the interest bill on America's debt. That's like using one credit card to pay off another, then asking friends and neighbors to keep lending you more. Eventually, even the most patient lender starts to ask, is this borrower really as safe as they claim? That's why this $119 billion auction matters. It's not just another sale. It's a thermometer of global trust. Will investors eagerly line up to buy, as they always have? Or will demand stumble, forcing Washington to raise interest rates even higher to lure buyers in? On paper, higher yields sound good for investors, but for the government, they're devastating. Every extra percentage point means hundreds of billions more in costs over time. And the traditional buyers? They're no longer guaranteed. China has been cutting back on U.S. bonds, pivoting toward gold and commodities while strengthening its ties with BRICS partners. Japan, once a reliable anchor, is now under financial strain of its own, selling treasuries to defend a weakening yen. Even oil-rich Gulf states are increasingly looking east, not west, for financial stability. In other words, this auction is more than just about raising cash. It's a referendum on America's financial dominance. So how does this auction actually work? Well, the Treasury doesn't just sell one giant block of $119 billion. Instead, it slices it into different maturities: short-term bills, medium-term notes, and long-term bonds. Short-term bills attract banks and money market funds, but the real spotlight is on the longer-term bonds, the 10-year and the 30-year Treasuries. These are the pillars of global finance. Mortgage rates, car loans, business credit, even foreign exchange reserves. All of it ties back to these benchmarks. This time around, the pressure is especially heavy on those long-term notes. Investors aren't just asking, will I get my money back? They're asking, what about inflation? What about the dollar's value? What if America's debt spiral makes these bonds riskier than they look? These are questions Washington has never had to face so directly until now. Traditionally, bond auctions were boring, predictable. Nobody worried about whether investors would show up. But in 2025, things look very different. The Federal Reserve has hiked interest rates to fight inflation, which means yields are already high. Not long ago, the government could sell bonds at just 1% or 2%. Today, buyers want 4%, 5%, or even more. On $119 billion, that difference isn't a rounding error. It's tens of billions in extra costs. Multiply that across trillions in new borrowing every year, and the scale of the problem is staggering. And while Wall Street's primary dealers, big banks like JP Morgan and Goldman Sachs, are required to step in and buy treasuries if demand falls short, even they have limits. If foreign investors retreat too far, banks may be left holding more debt than they can handle. That's when the system starts to strain. Meanwhile, inflation is still eating away at returns. Imagine lending money to Washington for 10 years at 4% interest, only to see inflation running at 6%. You're not making money, you're losing purchasing power. That's why investors demand higher and higher yields, driving US borrowing costs even higher in return. And the global picture isn't helping. China and Japan, the two largest foreign holders of US debt, are pulling back. The BRICS bloc is actively building alternatives to the dollar system, encouraging trade in their own currencies. Their long-term goal is clear: reduce dependence on the dollar and, by extension, reduce exposure to US debt. If they succeed, Washington will have to rely more heavily on domestic buyers and hedge funds. That's a risky shift. So what happens if this $119 billion auction falters? The effects wouldn't stay confined to Wall Street, they'd ripple through the entire economy. The 10-year Treasury bond acts like a compass for everything from mortgage rates to car loans. If Washington has to pay more to borrow, banks pass those costs on to families and businesses. That means higher mortgage rates, higher credit card rates, and higher borrowing costs across the board. For everyday Americans, a weak auction could feel like a credit squeeze. And the stock market? It thrives on cheap money. When borrowing is easy, investors flock to equities. But when yields surge, stocks stumble. We've already seen tech giants struggle as rates climb. If this auction pushes yields even higher, equities could face another painful hit. Then there's the dollar itself. For decades, its status as the world's reserve currency has been underpinned by strong demand for treasuries. If that demand weakens, so does the dollar. And while a weaker dollar might help US exporters, it makes imports more expensive, oil, electronics, raw materials, fueling inflation again. At its core, this is about trust. Trust that the US can borrow without limit. Trust that the world will always want American debt. But confidence is fragile. In today's digital markets, sentiment can shift in hours, not months. A weak auction doesn't just raise costs, it shakes the very foundation of America's financial reputation. And once confidence cracks, it's not easily restored. By now, you can see how this one event, this one bond auction, has global implications. And I'd love to hear your thoughts. Do you think America can keep relying on the world to fund its deficits? Or is this the start of a bigger shift away from US debt? Drop your perspective in the comments. I always enjoy hearing your take. Because here's what's really at stake. This auction is a stress test. If demand holds strong, Washington buys itself more time. But if cracks appear, borrowing costs could surge, the dollar could weaken, and the global system could start to question the unthinkable. Is US debt still the safest bet? History tells us empires don't collapse overnight. They unravel gradually through moments like this. Moments where confidence erodes piece by piece. That's why this auction is so closely watched. Its outcome won't just affect Washington insiders. It matters for every household, every business, and every investor around the world. Looking ahead, the questions remain. Is this just another bump in the road, or the start of a deeper shift? Can the US still count on foreign buyers, or will it have to lean more heavily on domestic investors? And how long can rising interest rates and stubborn inflation coexist before they finally break the system? The world is watching closely, and one thing is undeniable: the stakes have never been higher. So if you found this analysis helpful, please like the video, subscribe to the channel, and hit the notification bell so you don't miss future breakdowns on critical global finance stories like this. Thanks so much for watching, and I'll see you in the next one.